move that at any time, I swear.
Nice.
So I encourage everyone, if you have a question, please participate. I would love to hear your feedback. Again, I do try and keep up with all of the changes that are going on, but things are changing by the minute, by the hour. And most of you all are the ones that are out in the field and dealing with these situations on a daily basis. And if you hear something new or hearing of a situation where it may have changed, please chime in and let's chat about it. Okay, so let's talk about what sellers can do in a changing market. Let me flip over to my notes. So this one's pretty easy. Everyone hears about seller contributions, what it is, when, and how to do it. They talk about it, maybe a seller is being transferred, they need to sell within 60 days, priced at $250,000, and seller agreed to pay the buyer's closing cost. What does that mean? A seller contribution for my newbies on here, it's often called a concession. It implies the seller is giving in to some demand that the buyer makes, like throw in the appliances, make sure that you keep the spa that's in the backyard. That's considered a concession. A lot of the things that I used to see in the past, I haven't seen a whole lot of them lately, and I do have a feeling they are going to be making a comeback, is for a seller to pay a buyer's closing cost. Maybe they offer an extra $5,000 towards the purchase price, and they will in turn get $5,000 credit towards their closing cost. Another thing that I do see a lot of is when you have VA financing, your VA financing does have some buyer non-allowables, which are fees that the lender or escrow do charge, but the buyer is not allowed to pay per the VA. So the seller can always contribute a certain percentage or a certain dollar amount towards that to pay for those concessions. Any questions on seller concessions? Cool, let's move on. Seller funded permanent buy downs. This goes into, again, a concession where the seller is going to be helping the buyer buy down their interest rate permanently. So let's just say interest rates are at 5%, but in order for the buyer to qualify, they need to be at a 4.5% interest rate. The buyer will ask the seller to pay towards that concession for them to now qualify and be able to move into the home and permanently pay that interest rate. Does that make sense? Did I lose you guys? It's really quiet.
No, that makes perfect sense.
Nervous.
I'm following.
Okay.
Doing great.
So I actually haven't seen this in a really long time, but again, the world is changing and situations are changing. I used to see a lot of this back in the day when it was more of a buyer's market, and the seller would basically do anything that they had to do to get rid of the house. We kind of don't know what the future is going to hold. This may come back. Again, what I strongly recommend doing is making sure that it's going to be allowed on the buyer's financing. So check with your lender to see if that option is available for the loan type that the buyer is getting.
Yeah, Anita, I've been consistently for the last, I don't know, 4 or 5 years, been getting $5,000 in seller concessions, for closing costs, prepaids, out-of-pocket expenses, stuff like that, even in the seller's market.
Mm-hmm. One of the things that you also want to make sure you do is to make sure that it's allowed with the financing that the buyer is getting. And again, that's why it's super important to make sure that you have a strong relationship with your lending partners to make sure that you understand the type of product that they're getting when you're making the offers, that you know what the maximum amount that you can ask for in concessions. So if there's going to be certain loan amounts or certain loan types where maybe it's 6%, there's going to be other times where maybe only 3% is allowed. And your buyer may need a little bit more or a little bit less. You definitely want to make sure that you, again, are in contact with your buyer's lender and ask those questions. What can you ask for? Have them review your purchase contract before you submit it and say, hey, I'm going to write it up this way. What do you think? Will this work? And a lot of times they'll tell you, no, don't do it. Another pitfall that I used to run into in the past is agents would write, oh, just to closing costs, instead of wording it where it's seller to pay for the buyer's recurring and non-recurring closing costs, and lenders wouldn't like that, and they would only allow for the recurring closing costs and not the recurring closing costs, and the buyer would end up having to come in with more money and lose a portion of that credit because it wasn't worded according to the way the lender wanted it. So you definitely want to make sure that you are in communication with your lender and ask them, how do you or your underwriters want it worded on the purchase agreement, so that way we have a smooth closing. Any questions on permanent buy downs? We kind of went off into a tangent there. We're all good?
I'll chime in on that. I mean, here's the thing, Anita, interest rates are currently very low, and yet debt ratio requirements just got tightened up. So it may still be useful to ask about whether they're doing something like this can get somebody over the line of where they need to be, because you're looking at, FHA will fund up to about a 56.5% debt ratio, but almost every lender out there, other than like the one guy I sent you guys yesterday, has cut their FHA debt ratios down into the 40s. So an interest rate buy down may actually still be a useful tool, even though rates are already low.
Absolutely. Another thing that I used to see a lot of few years back, and it may make a comeback again, is going to be a temporary buy down. And what that is you can pay up a certain percentage towards the interest rate to temporarily buy it down. So say interest rates get away from us and we are at a 5-6%, let's just say, and the buyer can temporarily buy that interest rate down to their initial rate at 4%, and then it gradually goes on up over the years. So maybe they start off at the first year at a 4%, the second year at a 5%, and then 6% for the rest of the life of the loan. I used to see that a lot back in the, oh God, I'm going to totally date myself now, in the late 90s, early 2000s, when I was in the mortgage industry. And we did a lot of that, especially with FHA. Temporary buy down, get them in, and most underwriters will qualify the borrower at the starting rate. So it does help buyers get into the property where in normal circumstances, they wouldn't qualify at a 6%. Now, one of the things that I want to make sure that you talk to your clients about is, make sure that they're going to be in a position in 3 years to afford that 6% interest rate. I would always tell my clients, the last thing that I want to do is sell you a house and then have to turn around and either sell it because you can't afford it anymore, or even worse, sell it through the bank because you lost it because you can't afford the payment anymore. So do the best that you can for your client. Make sure that they understand. Make sure that you're working with a lender again that can explain what that means to them and what the final payment is going to be. Because again, maybe they qualified and they're happy and they're content at a 4% interest rate, but a 6% interest rate may break them. So that may not be the solution for them. We may want to go back and do a permanent buy down versus a temporary buy down. It may work for them if they know that in 6 months or in a year that they are going to be getting a raise or some kind of bonus. It's going to help them make sure that they can pay for that. So again, every situation is going to be different, and just make sure that you explain to your clients what the pitfall can be for doing a temporary buy down. Any questions on that? Nope, we're good. Okay. Let's go to owner financing. So I actually do see a lot of this, especially with some higher end properties. Buyer, for whatever reason, may not actually right now qualify through traditional lending, or may need some help with the financing. So maybe they get a first loan with a regular mortgage company that will only do a loan to value of up to 80, 85%, but they need some help with the down payment. So maybe the owner can finance a second for them to help them make up the difference in the down payment. They may not need all of the cash at that time. So it's really going to be dependent on the owner and what they actually need the money for. If they don't need the money right away, then it's a great option for them. Some owners may need to turn around and buy a property for them to live in, or they may need to put all their money back into a 1031 exchange. So it's just got to be the right fit for all parties. And then again, go back to your lender and make sure that that first mortgage will allow for a loan to value that's higher, a combined loan to value that's higher, and that it's going to be allowed for that financing on that first. Otherwise, you could set this all up, your lender goes in and said, I'm sorry, that's not allowed. So you got to do some homework. You got to get your lender involved, talk to the sellers or the agent representing the sellers, and make sure it makes sense for all parties.
Yeah, Anita, can I say something real quick?
Absolutely.
Yeah, you're going to see that a lot on the jumbos and super jumbos specifically in Southern California, where it's 75% loan to value, some situations even 70-30, and high wealth individuals are waiting on the sale of an asset down the line, or liquidating something in the stock market, something like that. So you'll see like a 5-year interest only with a balloon payment due. We see that a lot on the higher end, like the 1.5 to 2 million plus properties. So.
Thanks, Mark. Yeah, like I
You're
said, we do see it a lot on the higher end properties. I'm not sure how that looks for my Illinois and my Indiana people, if that's something that you guys do a lot, but it is a good option. Like I said, if it's the right fit for all parties.
And to piggyback on that too, it's not just the super high end. Oftentimes, because I know we have agents on the call here that work in the Inland Empire. Well, that's a different county, so the conforming loan limits are lower. So when you get a $600,000 or $600,000 home listed in the Inland Empire, that's a jumbo loan, and usually, generally speaking, those are not jumbo buyers. That's why it's a hard product to move, because the person who's buying a $600,000 home typically doesn't have 25 to 30% down. So that's a financing instrument that you can use to sell a property that was a challenge in the past.
Cool. Thanks, Mark.
You're welcome.
Okay, the next one is, I actually haven't seen a lot of this in my days. It's a contract for deed. And a contract for deed is sometimes also referred to as a land contract. And it's similar to an owner finance transaction, yet there's no mortgage. Ownership doesn't change hands until the entire sales price has been paid in full. It can go both ways for either the buyer or the seller. For a seller, it's easier for them to take back the property if the buyer doesn't make their payments. It's really to kind of minimize the risk to the seller, but it is a good creative way to help move the property and bring income in for the seller. The challenge is that the buyer technically doesn't own the property yet. They're just they're paying on something that it could create some challenges. So again, you got to make sure that it's a fit for all parties. And again, I haven't really seen a lot of it, so I don't have a lot of expertise to say on it. Alex, do you?
I can help with that. I mean, I've bought and sold property myself, several of them in this way. Mm-hmm. It does get pretty complicated. The only benefit of it is that because you're dealing party to party in regards to the money, you're not subject to a bank's underwriting standards. And every time I've bought or sold a property using this, it's because that was going to be a problem for one reason or another, right? I bought property on contract for deed, articles of agreement. It goes by a lot of different names. When I couldn't qualify for a mortgage, right? So, if mortgage underwriting standards get too out of control, this may end up becoming, a more used option. I would highly, highly, highly recommend Well, I don't know. You guys aren't an attorney state. In Illinois, we have attorneys on every closing, and I would really not suggest that anybody attempts to write the terms of this or even prepare the original offer without the guidance of an attorney, because you don't want to cross the line into legal stuff here, and you can't write a contract in Illinois as an agent. So just before you enter into anything like that, go and talk to an attorney that does these, or somebody in your office that knows what's what and where to stop and what you can do. They can be a really useful tool to get a deal done when financing is an issue, but they are kind of a house of cards. So yeah, so there you go.
And again, this only works if if the seller owns a property free and clear.
Ish.
Well, it could be illegal. That's what I said.
Well, there's nothing illegal about it. There's a risk. There's a risk if there's a mortgage on it. It'll probably not happen, but you got to know what the risks are and what the outcomes are based on if this happens, if that happens.
Yeah, because then technically, I guess that's considered a wraparound mortgage, and then it's due upon sale. So yeah, that's a whole nother type of transaction.
It's a rabbit hole. So know that it's there. And if you look like you need to go down it, come to somebody who really knows, from experience what they're doing with these, so that you don't go down the rabbit hole and mess it up.
Thank you, Alex. All right, seller seconds. Again, we talked about it a little bit on the other one with the seller financing. Seller doesn't necessarily need to move their monies right away to the next transaction. So they're okay holding a second. You definitely want to make sure with that first mortgage that combined loan to value is going to work with that first mortgage. And the lender will count that payment in their debt to income ratio. So again, you've got to make sure that you have that relationship with your lender and communicate what's going on, the type of financing that you're going to be doing, what the terms are, so they can calculate that into that first mortgage payment, and you're not going to have any issues or surprises coming in the middle or towards the end of the transaction. Another great value with a seller carrying a second is it does eliminate the need for private mortgage insurance, which can save your buyer hundreds of dollars a month and thousands of dollars annually, and a lot more over the term of the loan. Any questions on that one? That one's kind of easy, especially right now with the financing changing, guys. You definitely want to make sure that you're exploring all different kinds of options, seeing what works well for your buyer as well as the seller. So it is going to take a lot of communication and chatting with those other agents and figuring out like, okay, will this work for your seller? Is this even an option? And then if it is, or if it isn't, either proceeding or moving on to another property. So we're going to move on to the next slide, which is the lease with option and lease purchase. So it's two different things. I'm going to go into a little bit of an explanation. A lease with option to purchase is an agreement where renters have an exclusive right to lease the property for a certain period of time. And when that period ends, the renters can exercise their option to buy the property or not buy the property. So purchasing the property is optional. A lease purchase, agreements can work in any market conditions, and there are often solutions for someone having trouble selling their property outright and would consider a lease purchase arrangement to increase their cash flow or offset the mortgage payment of the house. So a lease purchase allows the landlords to set aside part of the renter's monthly payment for a down payment and or closing costs at the end of the lease purchase, or lease period, sorry. A lease purchase works well for buyers who haven't saved up for a down payment and who are having a hard time doing so. So we're going to go back up to the lease option. We decide to lease a property. Your lease period is 2 years, and it's basically giving you kind of first right of refusal to say, hey, I want the option to be able to purchase the property. Even if it's in the middle of the lease, the buyers or the tenant is going to have the first option to say, hey, I want to do this. A lease purchase is setting aside a part of that money that they're paying. So say their market rent is $1,000. They're going to pay $1,500, and $500 of that rent every month is going to go towards their purchase for their down payment and or their closing costs at the end of the lease term. You do, again, want to make sure that you talk with the lender and maybe even an appraiser to see what dollar amount is going to be allowed, because I believe most lenders will only allow the difference between what the market rent is and the amount that they're paying.
Fact.
I have seen people get in
That is a
trouble in the
fact.
past with this. So it is really important that you understand what they're going to allow. Alex, did you want to say something?
That is a fact. They will, you know, if this property, sorry, I'll use Illinois numbers.
No, that's
If
okay.
this property rents for $1,600 and you have a rent to own where it's $1,600 a month and it says that 300 of that is supposed to go towards a credit on the purchase price, they won't allow it. They won't allow any of it. So, you know, you would have to be paying $1,900, and it's the appraiser who will say what market rent is for that property. So, you know, they depending on how that plays out, they may or may not end up being able to, you know, to get credit for that.
Yeah, I've actually seen, I haven't seen it recently, but I have seen it in the past where they've made this arrangement without checking what the exact requirements are going to be or what the market rent is going to be. They believe that they have, you know, $10,000 available to use towards down payment and or closing costs. And then an appraiser comes in and says, no, you only have 5,000, and that could affect the financeability of the buyer. So it's a little bit tricky, but it can work. So you just want to make sure that you get the right people involved so you understand and protect both the buyer and the seller. Because if the seller is expecting that this property is going to be off their hands in 2 years and all of a sudden it's not, and they need to make other arrangements, you may have a seller who's not very happy with you.
One other thing I'll throw in on that,
Mm-hmm.
don't buy options in a declining market.
There you go.
It sounds common sense, but sometimes if you're eager or you're desperate, you know, you're paying money for the right to buy a property at a price that it's going to be worth less.
Mm-hmm.
So probably don't do that.
Your lease
Same.
option is probably your best bet, and saving the money on your own if you can. If you're going to pay extra to someone, might as well pay extra to put it in your savings account.
Right.
Hey, Anita,
Mhm.
with that lease option, does the first right of refusal, does that have to be written into the lease, or is that just standard language?
I think every state's going to be different. So you definitely want to check with your broker in your state. For California, you can put in the verbiage. I don't believe it is in the contract. I think it's going to be a separate contract. I do know for sure that a lease purchase is a completely separate agreement from the actual lease agreement. So again, you definitely want to check with your broker. I'm not sure for your state.
Okay, thank you.
Alex, do you know?
What was the question again, Anita?
You can there can be option language in the lease or you know, but the whole thing is, Ruben, you're going to need to have an attorney draft that document.
Right.
So either way, right, you're going to have an attorney draft that document. So.
Okay.
Yeah, because if you're trying to lease it and then sell it at a future date, you have to have the agreement completely done at the same time. But yeah, as Alex said, an attorney has to draft that document because you have to make sure the verbiage and all the wording is exact, and that you understand what money is for what and how is it all going to apply. Because it has to be appraised, and you have to agree on a purchase price that before the lease even starts at the future date.
But that's with your lease purchase.
Right.
Your lease option is just the same that when the seller is ready to sell it, they're going to give you the first right to
Right.
purchase.
Yeah, but that's separate. Those are two separate deals.
Yeah,
Got you. Thanks.
you're welcome. So my next favorite one, non-favorite one, is selling to relatives. So this can get a little tricky, again, with your lending partners. So you definitely want to make sure that they get involved. Some lenders or some loan programs do not like what we call non-arm's length transactions. So you definitely want to make sure that that it's allowed. Most of the time when you're dealing with a selling to relatives, or you have some kind of gift of equity that's involved, and again, you want to make sure that it's allowed with the financing that they're getting. They also need to make sure that the seller is not in default, because that could be a big red flag, and the first sign where they may say, no, we're not going to lend on this. So there's a couple of different things that you have to look out for. But again, the most important is to get your lending partner involved. Let them know upfront, hey, this is from relative to relative. What are my financing options? And we all know that we talked about throughout the last half hour or so that lending programs are getting tighter. It's not necessarily the FHA or the Fannie and the Freddie, it's the investor overlays. The investors are getting tighter on what they want to lend on. So it may be allowable in the normal underwriting guidelines, but the people that they're selling the loan to may not allow it. So again, it's super crucial for you to make sure that you communicate heavily with your lending partners, let them know this is the situation, and they can come up with solutions to help you find the right program for them. Let's move on. Oh, this is what we were talking about, Alex. The wraparound mortgages. So this is when there is a mortgage on a property and the seller is trying to sell or sells the property, but does not pay off that mortgage. This, from what I understand, is illegal in most states because most mortgages have a due upon sale clause. So you definitely want to make sure that you speak with attorneys about that situation. And I've never personally seen it happen successfully. Doesn't mean that it can't. It just really depends on the type of mortgage that is on that property. But again, most mortgages that I've seen out there do have a due upon sale clause, and that mortgage company is definitely going to want their money when that sale happens.
I'm gonna chime in.
Chime in.
Just because I've dealt with all this stuff a lot, for better or for worse. I would venture to say, and here's a disclaimer: I'm not an attorney. That it's not illegal. It's not. You're not going to be breaking any laws, but the seller is going to be breaching their contract with the bank, which is the mortgage, right? So it's not illegal. You're not going to go to jail, but you could be in trouble with the contract because every mortgage that I've ever seen does contain the due on sale clause, but it's not just sale. Technically, this is where you get into the gray area. Technically, if I lease the property to somebody else for 3 years, that could be considered a transfer of beneficial interest in the property and violate the due on sale clause too, because it's a long-term lease. If I sell an option on it, that could be violating it. The documents are written such that virtually anything that could affect ownership of the property is a violation of the due on sale clause. The question is, will the bank ever find out? And if they do, will they care? So it's a risk. I've been a part of these, and I've not had that problem happen directly. I've had other problems happen directly, but you would want to talk to an attorney. And I personally wouldn't give a client advice on this stuff at all. You have to say you got to talk to the attorney. Mm-hmm. But it is quite possible. I'm not giving anybody advice. It's really likely that if you did this, there wouldn't ever be a problem with the mortgage company, but there could. And you have no way of predicting and no way of controlling whether there ever was. So it puts you in a position where, yeah, if you weren't in a position to pay something off, it could create a big problem.
And another problem could be is that your lender that's trying to do a loan on this won't lend on it
Oh, you won't get a
not gonna-
loan on
Yeah,
that. No,
you
no.
won't be able to
It would
get.
have to be
first
seller
refunded.
financed wrapped
Yeah.
around an existing mortgage. Yeah.
Mhm. So, which will still be.
Yeah, it still
Well,
is all the same stuff. I'm just
still-
saying this, in this scenario, there's no lender on earth that's going to lend on that. I mean, there's no way. If you
This
had a
was a-
lender that was going to give you that loan, you probably wouldn't need to keep the first one in place. You'd be knocking out the first one anyway.
This was a tool that was used back in like the 80s when
Yeah.
interest rates were like in the
Interest rates.
20s.
A lot of these were, the contract sales and all this stuff was really popular with high interest rates, but it could also be used if financing is particularly difficult to obtain for other reasons. So, yeah. Fun,
Yes.
hairy stuff. Talk to your broker,
Definitely
call your
get-
attorney.
Yeah, definitely talk to an attorney. Make sure that your buyers and your sellers are talking to their independent attorneys to make sure that this is going to benefit all parties. And then definitely get your brokers involved because they need to know about it because it could come back in different ways. So get everyone involved that you need to get involved so we don't get ourselves into a realtor jail. We don't like the realtor pokey at all. So what can buyers do in a changing market? Funny, we just talked all about that, right? We're done. Bye. No, just kidding. So some of the options, and actually I've seen a lot of this, is using a 401k. Buyer doesn't have enough money in their savings, and they've been working at the same company for eons, and they've got quite a good little stash there. So that is definitely something that they can do. They do want to make sure that they talk with their tax person because there are definitely going to, well, not definitely, but more than likely going to be some tax penalties that they're going to have to pay. I did hear that right now the government is being a little bit laxed on that because of the COVID-19 crisis. Again, I am not a tax professional and I'm never ever going to preach on what's going to work right for you and for your taxes. So you definitely want to get your tax person or CPA involved so they can let you know what the tax consequences may or may not be for you when you're using your 401k. Alex, I see you getting antsy there.
Yeah, there's one way to use your 401k that is not a taxable event, and that's borrowing against the 401k. Typically, you can borrow up to 50% of your vested balance, and even though that amount's going to be a lot smaller right now, and there's no tax involved with that. In fact, any of the interest that you pay on the loan goes back into your account. So usually, it's not actually going to cost you any money, other than whatever lost opportunity growth you would have if the money was invested in the market. It'll pull the money out of the market and then give it to you. And you usually can do a 5-year amortization for any reason, or a 15-year amortization if it's for the purchase or renovation of a primary residence. But your 401k administrator is going to be able to give rules because some of them have different rules around that. The taxable event is if you actually withdraw money from it, in which case they're going to withhold 20% for payment of income tax and a penalty of 10%. So 30% of anything you withdraw is going to get cut right off the top. And Anita, what you mentioned about right now that's happening is that they're eliminating the 10% penalty. I don't know if they're still withholding the other 20% for income tax. It's still taxable. It's still taxable,
again,
but
I'm not knowledgeable enough on 401k and the tax consequences. So that's why I say, make sure that you get your tax person involved to see how it affects you and your family.
But there are some neat options there that may help.
Yeah.
For sure.
And then again, if you wanted to borrow from it, you definitely want to make sure that you talk to the administrator who's holding it, and your employer will more than likely, or their employer, I should say, will more than likely have that contact information and find out what those lending options are.
For sure.
Some of them are pretty lenient. Some of them are a little bit strict. Some people may have already borrowed against it. In the past, I have definitely seen that, and they think they can borrow some more and they may not be able to. So definitely make sure, again, talk to the lender, talk to the buyer, make sure that everybody is on the same page. If there is a loan against it, it may affect their debt to income ratio. So you definitely want to make sure that you talk to the lender and see how that's going to affect their qualifying for the loan. And I have actually seen it where it doesn't, and it usually will come out of the buyer's paycheck every month or every pay period. So another one is a temporary IRA transfers. Again, if you withdraw from your IRA, there are tax consequences. It's 10% penalty. In addition to the income tax due, that's with the income tax due on the withdrawal. It must be paid back in 60 days. So again, your buyer needs to definitely get their accountant or CPA involved to find out what the tax consequences are going to be for them. It may be their only option. So definitely get them involved, talk to the lender. They may have some tricks or tools to help them, or maybe even figure out another creative way to help them get their money. Any questions so far? We're at the 45-minute mark. I want to make sure everybody is okay. Do we need a break? Are we good? Should we keep going?
I need to step away for a few minutes.
All right, so let's just take a 5-minute break, little potty break, and then we'll come back in 5. So 11:49. I'll see y'all back here.
Okay,
Okay, see you back in a minute.
All right, thanks.
thank you.
Anita,
Yes, my dear.
how's the sunshine over there today?
It's hot. I had to put on the AC.
Oh, I
I'm
was
not,
hoping you would be like, I hope you would lie to me and say, oh, it's so gloomy and raining.
I can't lie about that. I'm too happy about it. Somebody's playing the happy song in the background right there. And I'm like, hey.
Oh, man. See what we got.
All right. It's 11:49. Who's back and ready to get going?
Do it.
Yeah. All right, cool. Let's go, guys. All right, this is one of my favorite and funny ones. Appraisable assets for down payment and closing cost. This is basically when people need to sell things because they don't have enough money, because you know that money underneath the mattress doesn't count. Sometimes they may have a car that they own free and clear that's worth quite a bit of money that they can get a loan against, or they can sell. You definitely want to make sure, again, I'm going back to talking to your lenders and make sure that this is something that's going to be allowed, because they do want to make sure that they can source where the money is coming from. And if they get a loan against that car that they've owned free and clear, that loan can affect their debt to income ratio. We've seen it happen again. Sometimes not all of the money is liquid, so they may borrow against it. Again, examples of the one that pops into my head is always, the car that they own free and clear. Now there's a payment on it. It could affect their DTI. Definitely check with your lender. If they sell some kind of, maybe they have a coin collection or something else of value that they're selling in order to get the cash that they need, we definitely want to talk to the lender and find out how they want that money sourced. And definitely make sure that there's some kind of paper trail and that it's going to be allowed on their loan. So that way it doesn't affect the financing and you're not stuck at the end of it having to show some more money. Any questions on that? I know that one's a little weird, but I have seen it happen many, many times. We're good? Can I keep going?
Yeah, keep it going, girl.
All right, cool. All right, pledged asset mortgages, PAMs. I've seen a lot of these when, especially for your high wealth individuals, they have a lot of money, but it may not necessarily be liquid. So we do see a lot of times where they have a stock portfolio, and instead of withdrawing all of that money out of the stock market, someone will lend against that money. And it's usually, when I see it, it's usually private money, like your JP Morgans. They usually can lend against the portfolio. They have what they need to verify, and they know how much they'll borrow against it. I don't know if that has changed right now with the volatility in the stock market. So definitely get in contact with whoever is lending against that money or that portfolio, and make sure that it's going to work and that they're going to have either the funds liquid or the loan available when it's time to close. Any questions on that one? Because that one's probably not something that a lot of people see. Cool. I'm just going to keep
Yeah,
going.
we're cool. Just keep going.
Okay. Equity transfers and bridge loans. Bridge loan is usually when buyer or seller needs to sell a house and in order to buy the next one, but they know that that sale isn't going to go through. So there's the money is coming, but it's just not there yet. There are a lot of lenders who will do a bridge loan to help them temporarily use that money to purchase. And then once their assets or the home sells, then they pay it off. This will usually happen with people who do have enough equity in the property that they're selling. I haven't seen a lot of it lately. I did see a lot of it back in the day, so I don't know if lenders have tightened up a little bit on the bridge loans. I don't know if anybody has done one recently. Anyone out there?
I haven't done one recently. I did one last year, a couple of them last year actually, but like after the summer, it kind of, a lot of lenders are kind of tightening up on that.
Yeah, I haven't seen a lot of them lately. I want to say it's probably been at least a good 2 to 3 years since I've seen one. I used to see them a lot. They may come up again. Again, check with your lender to see if that's something that they offer or if they have a source for a lender who does do bridge loans, and just make sure that it's not going to affect their financing. And again, just make sure you get the lender involved to see how that's gonna look for your buyer.
Yeah,
But
here in Illinois,
it's definitely a short-term option while you work on that sale.
yeah, here in Illinois, the lenders weren't promoting it. Like after the 08, they weren't really promoting it, but some of them offer it. You just have to ask.
Yeah.
Kind of one of those things like if you don't ask, we're not going to tell you about it.
Don't ask, don't tell policy,
Right.
So another option that I actually still do see a lot of this is down payment of gift funds. So they use the challenge or the example here. Buyers are a newlywed couple, and mom and dad are like, hey, here's your wedding gift. We're going to give you $50,000 to go buy a house, which is awesome. If my parents could do that, I would totally take them up on it. Actually, if any of you all are willing to do that, I'm totally willing to take you up on it. I'm just saying. Definitely, again, I'm going back to making sure that this is going to be allowed with your lender and the loan program that they are using, because some of them do have limitations on gift money. Sometimes they do require that a certain portion of the down payment come directly from the borrower, and then the additional monies can come from as gift money. There are times where the whole down payment can be gift money. There are a lot of times where the lender is very strict on where the gift money comes from. It does need to be a blood relative in a lot of instances. So again, check with your lender so they can check the guidelines and their investor overlays to make sure that those funds are going to be allowed. And then also make sure that you work with your buyers to make sure that they source it, and make sure that they understand that the lender may require the person who's giving them the money to source the money. That has been a big sore that I've seen in the past. So mom and dad have $1 million in the bank. They're giving away 50,000. Lenders saying, okay, I need to see the money from your parents. And the parents are like, why? That's my money. So prepare your buyers to prepare the parents or wherever they're getting the money from to say, hey, I may have to source where this money is coming from, and I may need to get a bank statement, or I may need you to talk to the lender and give them something directly. So again, work with everyone, communicate that additional verifications may be required, talk to your lender ahead of time, find out what's going to be needed. Find out how they want the money deposited. Do they want the money to go straight into escrow? Do they want the money to be deposited into the buyer's bank account first? Again, there's so many just little things that we want to make sure that are going to be okay with the lenders. Every lender is different. Every investor is different. So please make sure to communicate with everyone and figure out how to best guide your buyers. Because I have seen in the past where they make a mistake, they don't think about it, they just act and it blows the deal up. And then you're having to turn around and retrace your steps or go through another source. Well, meanwhile, you're thinking everything is hunky-dory. And at the end, you've got a big fire that you're trying to put out.
And then they're mad at you because you didn't tell them.
Exactly. Exactly.
Theoretically, never dealt with that myself.
Yeah. Yeah. So again, just, and I keep going back to the lender on this is, you know, get an understanding of what they're looking for so you can help guide your buyers. Because at the end of the day, Alex is right. They're going to come back and they're going to look at you as the bad guy. So if you are able to help guide them and give them as much knowledge ahead of time, and really hold their hand through it, they're going to love you and praise you, and they're going to be a great referral source for you at the end. Oops, sorry, I lost my screen here. Give me a second. Okay, my next favorite one is non-occupant co-borrowers. This is where you have someone who can help you finance the property, but it's not going to live in the property. Again, I sound like a broken record, but you want to definitely make sure that you talk to your lender to make sure that a non-occupant co-borrower is going to be allowed. You may think that, oh, my mom's going to help me buy this property. However, you may not be factoring in what their debt currently is and what their mortgages are. And certain lenders will only allow a certain portion of their income to be used. They may not allow all of their assets to be used if they are married and that other spouse is not on the loan with you. So there's a lot of different factors. 1000% always make sure that you get your clients not just pre-qualified, but pre-approved with the lender so that an underwriter is looking at all of these different factors and they can tell you exactly what's going to be allowed and what's not going to be allowed. So that way, when you're actually under contract and in escrow in California, I don't know if you guys are in escrow state, I don't think you are, that you know what you're dealing with and there's no surprises in the middle of it. If you're in the middle of a transaction and the homework wasn't done ahead of time and they've fallen in love with the house and now they can't afford or can't purchase this house because there was something that, you know, you didn't anticipate, you're the bad guy. And again, just make sure that it's allowed. I really haven't seen a whole lot of problems with non-occupant co-borrowers other than people not factoring in all of their debt and now your new debt with a new mortgage and then them still not qualifying. Any questions on non-occupant co-borrowers?
The VA will not allow non-occupant co-borrowers.
Oh, there you go. VA will not allow it.
I wanted to add something. I actually was in a situation being self-employed. After I got divorced, I had a hard time getting a loan since my income varied quite a bit from year to year.
Mm-hmm.
And so my lender said, in order to get the house I wanted, I need to maybe see if I can get a co-borrower. So my dad was a non-occupant co-signer. And the biggest thing that we were looking at is to make sure I could still get my homestead and mortgage exemptions, because my dad also had mortgage and homestead exemptions on his house. So it's just something else to consider when you're writing an offer and you've got a non-occupant co-signer that your lender, my lender worked with me and he made it happen, but I've heard of people losing that exemption if they have a non-occupant co-signer that sometimes the county won't work with them.
That's good to know. Anybody else have any good examples like that? I see it a lot with first-time home buyers, especially with FHA. And again, there are going to be a lot of restrictions, and FHA has definitely, well, maybe not FHA necessarily, but the investors purchasing FHA loans, they have tightened up their qualifications, their restrictions, everywhere down from the debt to income ratios now till credit scores are higher. I knew that there were some lenders going down as low as a 580 FICO score. And I'm hearing rumors that now it's up to 660. Again, you definitely got to check with your lender to see who they're selling these files to find out what they're looking for. Things can change daily. So we've seen that over the last few months. So make sure that you're actively communicating with your lending partners to make sure that your client is, still good to go. And if there is an opportunity for you to close early and it works for all parties, I'd say close early. Again, things can change in a heartbeat, especially with everything that's going on in the world today. And we want to do everything that we can to protect our clients. Any questions on that? All right, cool. Employer assisted mortgages. An EAM isn't necessarily a mortgage, although it can be, but it's mortgage assistance that helps employees buy their homes. So there are going to be employers that will provide like a down payment assistance. They may also work with lenders who will give them a discount on their rate. So they may have partnerships with them. And so you definitely want to check with your lender to make sure that that is going to be allowed, because the investor that they may be using may not allow it. Again, it's kind of it could be a gift. It just depends on the type of incentive that the employer is asking. So get the information from the employer and then take that to your lender and make sure that that's going to be allowed. Any questions? Has anybody seen this recently? I haven't.
Nope.
All right, what lenders can do in a changing market? They can just stop changing the guidelines every day, right? It would make our lives way easier.
Every day. How about every like half a day, every 30
Right.
minutes?
So lending has changed so much since when I first started. I don't know if I mentioned in the beginning, I started my real estate career in the mortgage industry. Started off doing some subprime loans. I did some crazy stuff back in the day. 10, 15% interest rate, 60% loan to value, but I saved some people from foreclosure and it was awesome. And I made a lot of money from it. And I think that's the reason why everything went to crap. I'm not going to lie.
So it was your fault?
It wasn't my fault because I only did it for a year because I didn't like the feeling of gouging people like that.
Okay.
So I was very
We won't blame
fortunate.
you.
I was very fortunate to go into and meet some really great mortgage people. I worked with Wells Fargo mortgage company for a while, some other independent mortgage companies for a while, and I learned a lot. There was even a time where I had my own brokerage, and within the brokerage, I had a mortgage company and an escrow company, and we did a lot of business. We helped a ton of families. But things have changed mighty drastically since those days.
Man, you're kind of like a superwoman, Anita. Good grief. That is a hell of a resume.
Yeah, I've done a lot of things, kids. I'm a lot older than I look.
For sure. 100%. Yeah.
You see the hairy guy that keeps walking back and forth? That's actually my kid. But yeah, I've been really fortunate to see a lot of crazy things happen. And back in the 2008 meltdown, I wasn't one of the people who just survived. I actually thrived and was very lucky and very fortunate. But like I said, things have changed a lot. And that is why I keep harping on the fact that you've got to make sure that you partner with the right lending people who are knowledgeable, who understand the type of programs that they're putting your borrower into, and also making sure that they are staying up to date with the changes that are happening, like Ubaldo said, every hour, just about. But lender funded buy downs. So you can always pay points, or the lender can help you pay some points to help buy down your interest rate to help you qualify. I haven't seen a lot of the lender funded buy downs recently. I used to see them a lot back in the day. What I have seen is lender doing credits to the closing costs. So the buyer is going to pay a slightly higher interest rate to get money back to pay for their closing costs. Well, not necessarily like cash back, but money back towards their loan. And usually a slight adjustment to the interest rate won't hurt the client. Again, you never know. Make sure that you work with that lender so they can tell you exactly how much they're going to be crediting, so your client knows exactly how much they need to go in and either save for or show that they have money in. Any questions on that? No? All right, My Community Mortgage. This is a Fannie Mae product that is designed to help first-time home buyers overcome down payment problems. I haven't seen a lot of these. I used to see them back in the early 2000s. Has anyone recently done a My Community Mortgage?
Nope.
I don't have too much insight on it because it's been so long.
In a rural county, I did a deal. It wasn't called My Community Mortgage, but it was, reading that profile, that's what it was.
Mm-hmm.
And they did perform down payment assistance also.
The USDA in like less densely populated areas will offer 100% financing under similar situations like that too.
Yeah. So this was outside. So this was more in city center versus, so it was a rural county, but it was in the city in the county seat. And so it didn't qualify for USDA, and that's how they offset that program, Mark. But you're absolutely right.
Yeah, back in 2005, 2006, there was a similar product called the Acorn loan. It was through Bank of America, and it worked with Acorn. It was 103% financing using alternative lines of credit, so on and so forth. But that was the beginning of the subprime meltdown.
Yeah, like I said, I haven't seen it. I haven't seen it lately. I remember seeing it back in the day, but I for the life of me, can't remember too much about it. So definitely check with your lender and see if that's still something that they have an option for. With the alternative credit history, I have seen FHA do that in the past to help build trade lines if they don't have enough trade lines. So again, I keep going back to it. Make sure that you have those conversations and get your buyers pre-approved so you know exactly what you're dealing with.
I remember that Acorn program, and while I think that is long gone, as you mentioned, there is another one that's it's a down payment assistance thing that's, I don't think it's like for Illinois. I think it's a general thing. Yeah, it's based out of Utah. It's called Chenoa. The lender that I shared with you guys the other day, who still is writing FHA down to 580 and manual underwrite to 500 and all that stuff, is doing those as well. Those are 100% financing. There's a forgivable grant that's a part of it. And they can get credits and everything too. So, that particular lender seems to be the only one doing any of the, I don't know, fringe programs right now that many others have eliminated.
I mean, I have seen the down payment assistance programs. I know Mark saw like the Cal Halfas. Remember like the Cal Golds back in the day, Mark?
Yeah, they wrapped them in with FHAs because
Yeah.
they were basically gifting or granting the down payment on the FHA loans, and so
Those were like up to 103% financing.
Right. And then there was like, if you sold the house with it had a soft and a hard prepayment penalty. There was no interest on the house other than if you were to sell it within 5 years, you had to pay the money back with interest. So it was promoting long-term home ownership and just so people wouldn't just abuse the system so they could cash in on government money and for a profit.
Yeah, but I think those ones still had to qualify for an FHA first.
Yeah, the county out here, in Orange County, they had down payment assistance programs for like 5% grants up if your income household was under 180, which was nuts. Like a household making $180,000. People buying $700,000 houses with down payment assistance. It was pretty gnarly.
I need down payment assistance. So what are you talking about?
Yeah, I just was like, really?
Our average price point is
$180,000?
$700,000. It's crazy. All right, our next one is leveraging automated underwriting systems. This is also known as your DU, your DO. I think for Freddie Mac, it's LP. So basically, loan officer goes and types in all your information as accurate as they can into the system. It may not actually qualify under normal underwriting guidelines, because normal underwriting guidelines for a conventional loan, I believe that their max DTI will be like 42%. If you go and you run it through the DU, LP, or the DO, you may end up getting an approval with a higher debt to income ratio. Don't quote me on what the guidelines are for the debt to income ratios. I've been out of that game for a little while. So definitely make sure that you speak with your lender, find out if this is an option, because the automated underwriting guidelines are usually a lot more relaxed than your manual underwriting. Another thing that I am seeing that is really helping a ton of people right now is that they have gone and modified the system where, depending on where the property is and depending on the sales price and the automated value that they're getting back from the system, it may actually give you just a drive-by appraisal, which is really helping right now, so appraisers don't have to go in and view the property. So these desktop underwriters, LPs, DUs, DOs, whatever acronym you want to use, are really helping us make sure that we get deals done right now. Has anybody seen anything else that DU or LP or DO or whatever 2 letters you want to use or help get approved that wasn't able to get approved in the past?
In some situations, I've got lenders that will do manual. The desktop can be tricky with certain situations, and I actually would imagine coming out of this with people who have been furloughed and then get their job back, there's no way in hell it's going to go desktop underwriting. Is going to have to go manual. They're going to have to get LOXs and all that stuff. I mean, wouldn't you imagine in your experiences that's exactly what it's going to be? I mean, here's a pretty typical scenario of some people that I'm dealing with right now, Anita, is that especially like in the hospitality industry, right? So you're looking at people who are running convention centers, people who are running hotels, right? So they get furloughed and then maybe they lose their job, and so then they have to relocate, right? And then no one's hiring, right? So you're looking at, right? So they're not gonna come from Indiana to California, and then the Hilton's like, oh yeah, sure, let's go ahead and put you on the books. So it might be another 90 days before they get income. So I mean, that's not going to get approved on desktop underwriting, and yet it wasn't their fault why they had a hiccup in their income in order for them to be able to so qualify. Should they be penalized and have to wait 12 months, 24 months to purchase a home when they had to relocate across the country? Probably not. You know what I'm saying?
There may be an option where the people who help underwrite this go in and modify the system to help with that. I mean, like I said, they've gone in and they've modified it to where now there's like almost every file that I'm seeing go through is using some kind of appraisal waiver or drive-by. So they may modify it down the road. Like I said, this is stuff that's changing every single day, and it's so hard to figure out or see how it's going to play out, and it's going to be kind of fun to see how it plays out.
That's what I was thinking. Yeah,
I'm fairly confident with basically 10% of the population being on some sort of unemployment at this point, that the mortgage companies are going to really look long and hard, and so will the HUD on exceptions moving forward for that specific scenario. People who were furloughed, their W-2s are not going to be indicative of their monthly income. So maybe they'll start taking monthly averages rather than annual averages. I'd have to think, because the banks don't make any money unless they're generating new mortgages. So like there's probably most likely going to be some sort of exception. And I would think, at least.
I would think so too. Like I said, they're thinking of all kinds of creative ways, and it's got to make sense for the investors who are purchasing these things. So we got to literally play it day by day. The cool part is that they know they've got to do deals in order to stay in business. So we may see some crunch right now, but I have a feeling that it may not go back to normal, but we'll have a new normal soon, and we'll be able to better help guide everyone when that happens. And again, the most important part is staying in constant communication with our lending partners to find out what the changes are, to find out what the investor overlays are, and to maybe even find some people who don't have all those crazy investor overlays, who are selling to servicing the product directly, where they don't have all the craziness going on top of it. So there's a couple of different things that people may want to look for when they're interviewing lenders to work with. So another option to help buyers qualify is adjusting the amortization period. We've all seen the traditional 30-year mortgages. I have seen 40-year mortgages come up. What the guidelines are for those, I couldn't really tell you. So again, talk with your lending partners. Sometimes if you get a lower mortgage, like 20-year, it may actually change your interest rate for the better. So that may also help them qualify, even though they've got to now pay that off sooner. So their payment might be a little bit higher. So definitely talk with your lending partners and your clients to see what best suits them and what makes most sense for them. Adjusting interest rates to cover the closing costs. So we talked a little bit about this earlier. So lender can increase the interest rate a little bit higher to help pay for some of those closing costs. Because rates are changing daily and maybe even by the hour, you definitely want to, again, check with your lending partner to find out what they can do to help your client. And there's even an option, I don't know if maybe we talk about this in a little bit, but there's an option where the seller can pay towards the closing costs. Actually, we did talk about it earlier. So there's a bunch of different ways to help with that if your buyer is a little bit short on the closing cost. And just remember, talk to people. Don't just assume. Make sure that you communicate to make sure that it's available for the loan product that they are purchasing. We talked a little bit about this estate and local grant and bond programs. Lending is tightening up, so there may not be the down payment assistance programs available. A lot of states are on like a temporary shutdown, or they may be working on limited capacity. So they either may have the money, but they don't have the people available to underwrite the grants or the loans. So definitely, again, check with your lending partner, see what's available to your client. If you're out there actively looking for someone who was a pre-approved, go back and talk to your lender and make sure that they still qualify or that program is still available for them, because things are changing, like I said, daily. And who's writing on my screen? Nobody's going to claim that.
That's awesome. But now we know what we can do.
I don't know how to write on the screen, so.
Only the host can write on the screen. It's Corey.
Someone's a host.
It's not me, I promise.
It's Corey, Ubaldo, or Anita.
At least you didn't draw anything questionable.
Yeah, I've seen some replay Zoom
Uh-oh.
calls where there's
Oh,
definitely
I seen a good one
questionable
the other day.
scribbling.
So MCCs, I haven't seen these in a while. It's a tax credit. I'm trying to figure out the best way to explain this.
Basically, you were taking what you would receive back at the end of the year as a
Yes.
tax credit up front. As I mean, just like there's like the stimulus checks everyone's applying for. You're borrowing against next year's tax return based on what they think your mortgage deduction would be.
Thank you, Mark. I don't know why I was struggling to come up with that. I haven't seen a lot of that program lately. I did see it back right before the mortgage crash. It could still be out there, but again, I just haven't seen it personally. I don't know if anybody else has. No? Okay. Expanded alternative lending. So might go back to the subprime lending after all, Alex. I don't know. We'll see.
We'll see. We know what to do.
So this is alternative financing for those who necessarily qualify. Oh, no, I'm sorry. I'm reading the wrong one. This is your expanded alternative to underwriting, to your automated underwriting. So this could be a file where it doesn't necessarily fit the parameters of a normal Fannie or Freddie, but they will allow it if they pay additional monies. So it may cost them an extra 1/4 to 0.5% in order for them to get the loan. And it's an expanded guideline within Fannie Mae and Freddie Mac. They have to receive an automated approval with a EA 1, 2, or 3. I know that it's basically EA expanded alternative. If they qualify, it does need to be manually underwritten. And as long as it fits those guidelines, they will qualify for that mortgage, but they do need to pay a little bit of extra money in order to get it. Make sense? All right, I'm going to take that as a yes.
Yeah, that makes perfect sense.
Yes, that makes sense.
Subprime lending. There we go, Alex. I spoke too soon. These are riskier loans. They'll pay a higher interest rate. More than likely will require a larger down payment. It's not usually done through your traditional banks. So it does cost more money to get it, but they are out there. And they'll be very straightforward on what they'll accept and what they won't accept.
So Anita, sorry, go ahead.
No, go ahead.
I was going to say, I saw something probably around the beginning of this month that there's really like 2 major non-QM lenders out there, and that they both had frozen lending. So I don't know if that's undone yet or if it's planned to be or what, but that really cut out like 99% of what was available within this. There's really only 2 of them that write them.
My son actually works for a mortgage company, and I want to say within a week after pretty much the world shut down or the US shut down, they did make an announcement that they were halting all of those loans.
So as far as you know, that hasn't been unhalted yet.
As far as I know, no, but I haven't gone back in to look at it.
Okay, nor have I.
Yeah. What I preached there and saying to make sure that you're, I don't have any current clients that I'm working with, so that's why I haven't gone in and checked on this particular type of file. But there are other investors out there who specialize in subprime lending and will do it.
Yeah.
So they may be a little bit harder to find, but I know that they are out there, and this is how they make their money. They are going to charge you higher interest rate. They're going to they may charge you more on points. They may require more of a down payment, but they'll finance it and they'll get you in that house.
For sure.
Private lending. I think I just saw Robin had said that she found a great portfolio lending products through many lenders. Robin, is she still there? Did I lose her? It's getting exceptions on loans when they don't fit the standard overlays or end investor requirements. That's great. That's a good source, Robin. Please share that with your people. So private lending, they're going to be a little bit more laxed on some of the requirements. They may ask for a higher down payment, but the rate will still be somewhat competitive. And they may also accept some alternative sources of cash that other traditional lenders won't. So if you have access to a private lending firm, please share that with your people, because that I think is actually going to help a lot of people in the next few coming months. And then the no document programs. This is what got us into trouble back in the day. People were doing stated income, stated asset programs with people who should not have been stating their income or the assets. There are still some programs out there that do have a no doc program. These programs are mainly designed for your self-employed people, such as realtors, who do make the money. They do have the income coming in, except they may not tell Uncle Sam all about it all the time. They may write things off that they probably shouldn't be writing off. So at the end of the day, they are making the money. They just can't prove it. So check with your lenders, see what investments they have available to help your clients who don't necessarily have the income and the assets to prove traditionally that most lenders will require.
This is also very popular for like servers, bartenders, hairdressers, people like that. And I think the last one I did, we had to provide 12 months of bank statements just to prove that there was and they just averaged out the deposits over the 12 months.
Any questions so far? Oh, any questions
Anita, I had,
at the end? Go ahead.
Anita, this is Ron. I did have one question kind of to you and Alex. Can you kind of explain the difference between a qualified loan versus a non-qualified?
So a non-qualified is gonna be kind
Start
of
with what a qualified is, because the non-qualified is
qualified
everything
is your traditional FHA, Freddie Mac, Fannie Mae, where you're able to provide and source all of your income, all of your assets. Your FICO scores are in line with the normal lending guidelines. And then, so your non-QM, am I saying this correctly, guys?
Yes.
Yeah, okay. Your non-QM is going to be kind of the opposite, where you may have, your stated income. You have to show your 12 months of bank statements to show that you have the income coming in.
Okay.
So it's still a good loan program. However, it's just an alternative way to source your income or your assets.
Okay. I always think of the qualified loans as more the traditional lending. That might be something you get from Chase or Bank of America. But when we just talked about the no doc, I was kind of thinking of the non-qualified loans.
Mm-hmm.
I'm just hoping I'm thinking about that right.
Yeah, any non-qualified mortgage, the whole thing in order to be a qualified mortgage is that there are, even if it's not a conforming loan, meaning Fannie and Freddie to be sold, to them, that it still actually has, there's still a requirement federally that they have to make sure the borrower has the capacity to repay. So QM includes conforming loans, which is Fannie Freddie, and all the government-backed loans like USDA, VA, FHA, all that stuff.
Okay.
So those all have those requirements, and everything outside of that, non-QM, is like the Wild West. Hey, lender, make your bets, but no one else is going to buy that loan off your books, and you're on your own.
I got you. I got you. Thank you both. I appreciate it.
No problem. So there's so many alternatives out there, guys. Again, I'm going to harp on the fact that you do need to have very strong, trusted lending partners on your team, because they're literally a part of your team. And you've got to be in communicative with them almost, I wouldn't say hourly, because that's a little bit crazy, but you do need to check in with them or have someone who checks in with you daily to give you updates. If you're working with them on your clients, you do need to check in with them as often as possible, because the circumstances could change at any time. The programs can change at any time, but make sure that they know what they're doing, that you trust them. They know and understand all the different outside of the box thinkings, because that's going to have a huge effect on all of the business moving forward. So thank you guys so much for being a part of the shift today and financing. Any questions
Yes.
that I can help with?
I got to log off for my next call, but thank you very much, Anita. That was awesome.
Thank
A lot
you
of
for your
knowledge
input,
there.
Alex. I really appreciate it.
Thanks,
Anita's
Anita.
super knowledgeable, man. You rocked it. Thank you.
Thank you so much, Anita. Really appreciate it. Thanks for your
Thank you,
time.
guys.
Thank you.
Anytime.
Very good.
Thank you.
Thank you.